The 60/40 portfolio, 60% stocks, 40% bonds. The classic investment strategy. And it's been making a comeback this year after a pretty dismal performance in 2022. So today, we're going to unpack why this strategy, which likely impacts your portfolio in some way, is working now. What went wrong back in 2022? And we're going to delve into a really important concept, the correlation between stocks and bonds.
Well, 2024 has definitely been a good year so far for this 60/40 portfolio. Diversification, which is the very foundation of this strategy, really proved its worth in the third quarter.
Can you elaborate on that? What exactly happened?
So when we saw stock market drops in the third quarter, bonds acted as a buffer, softening the overall impact on a balanced portfolio. So for example, if we look at between August 1st and 5th, and again between September 2nd and 6th, stocks fell, but bonds rose in value. And this provided a cushion for investors holding that diversified 60/40 approach.
So diversification is back in style. Why did this happen in 2024?
Well, two key factors contributed. First, investors were seeking safety in bonds amidst all the market volatility. And second, anticipated Federal Reserve rate cuts in September pushed bond prices upward.
Yeah, that makes sense. But 2022, that was a completely different story for the 60/40 portfolio, wasn't it?
Oh, yeah. 2022 was a historically bad year for the strategy. The S&P 500 had its largest loss since 2008, and the U.S. Core Bond Index experienced its worst year ever recorded. The Morningstar U.S. Moderate Target Allocation Index, which is designed to benchmark a 60/40 portfolio, showed a significant loss of 15.3%.
Ouch. So in 2022, diversification didn't work as intended. What happened?
Well, the diversification benefit was almost non-existent because both stocks and bonds fell simultaneously. And this unusual behavior brings us to a really critical concept, correlation. Correlation measures how stocks and bonds move in relation to each other, a negative correlation, where one asset goes up while the other goes down. That's the bedrock of diversification. Think of it like a seesaw. When one side goes down, the other goes up, keeping the whole thing balanced.
That's a helpful analogy. So what happened to that correlation in 2022?
Well, since the beginning of 2022, stocks and bonds have actually had a positive correlation, meaning they moved in the same direction, and that negated the diversification benefit. This shift is a significant departure from the historical norm. For instance, the correlation between short-term Treasury bonds and stocks jumped to a positive 0.51 since 2022, compared to a 20-year average of negative 0.12, and long-term Treasury bonds show a similar trend, with a positive 0.67 correlation since 2022 versus a 20-year average of negative 0.10.
Wow, those numbers really illustrate how dramatically things shifted. But what caused this sudden change in correlation?
Well, the primary driver was the environment of high inflation and rising interest rates that prevailed throughout that period.
Can you explain how inflation and rising interest rates impact that correlation between stocks and bonds?
Sure. Higher discount rates, which are influenced by interest rates, lower the present value of both stocks and bonds, making them less attractive to investors simultaneously. I like to think of it this way. Imagine you want a toy that costs $10 today, but if you wait a year, it might cost $11 because of inflation. That extra dollar is like the discount rate, making the toy less valuable today. When discount rates increase due to rising interest rates, both stocks and bonds are perceived as less valuable in today's terms, and their prices tend to fall together.
So they both start heading south together,
Yeah.
negating that seesaw effect we want from diversification. Are there any other contributing factors at play here?
Yeah, high interest rates also dampen consumer and corporate spending, which can slow down economic growth, and as a result, corporate profits. This further adds pressure to stock prices. So it's kind of a domino effect, stemming from that initial surge in inflation and interest rates.
So it sounds like 2022 was a perfect storm for the 60/40 portfolio. What's the key takeaway from this experience for investors?
The crucial takeaway is that correlations are not constant. They are dynamic, and they change over time, defying investor expectations.
So are you saying that diversification is no longer a reliable strategy?
Not at all. The fact that correlations can change is precisely why diversification remains so important. It's about preparing for a range of scenarios, even unexpected ones. You need a strategy that can adapt to the ever-changing dynamics of the market.
That's a good point. Can you provide some historical context to highlight the dynamic nature of these correlations?
Sure. If you look at the years since 2000, stocks and bonds have actually moved in the same direction for 18 out of the past 25 years.
That's surprising. So the negative correlation we expect hasn't really been the norm.
It's less common than many investors realize. What's even more surprising is that in 17 of those 18 years where stocks and bonds moved together, returns were positive for both asset classes. They were both going up.
So it wasn't a bad thing that they were correlated. It was just when they both went down, like in 2022, that it became a problem.
Exactly. 2022 was a historical outlier. It was the first time since 1980, when the Bloomberg U.S. Aggregate Bond Index was launched, that both stocks and bonds ended the calendar year with negative returns.
Okay, so we've seen how diversification made a comeback in 2024, with bonds once again cushioning stock market downturns. But we also revisited that stark contrast of 2022, when the 60/40 portfolio faltered, due to that positive correlation between stocks and bonds.
Right, we delved into how high inflation and rising interest rates really drove that shift, highlighting that these correlations are dynamic and they change over time.
And critically, we emphasize that while this dynamic nature poses challenges, it underscores the continued importance of diversification as a core investment principle. So with that foundation laid, what alternative diversification methods could investors consider in a world where those traditional correlations might be less predictable?
One increasingly popular approach is to broaden the scope of your portfolio beyond just stocks and bonds and include alternative asset classes like real estate, commodities, or even private equity.
So the idea is to add assets that haven't historically moved in lockstep with stocks and bonds, creating another layer of diversification. Could you provide an example how this might work?
Let's imagine a scenario where stocks and bonds are both declining due to rising inflation. Real estate historically has often performed well during inflationary periods, acting as a potential hedge. So adding real estate to a portfolio could help offset some of the losses in stocks and bonds. However, it's crucial to remember that no investment is entirely immune to market fluctuations.
So there's no guaranteed hedge. Investors need to do their research, understand the risks associated with any alternative asset class.
Absolutely. It's not about throwing darts at a board. You need a strategic approach. Working with a financial advisor specializing in alternative investments can help ensure they align with your overall investment goals and your risk tolerance.
It's about building a portfolio that's tailored to your needs and your circumstances, not following a one-size-fits-all approach. Are there other approaches besides alternative assets that investors can consider?
Another area worth exploring is factor-based investing. Instead of picking individual companies or bonds, factor investing focuses on specific characteristics or factors of stocks and bonds that have historically been associated with higher returns or lower risk.
So instead of betting on a specific company, you're betting on the underlying factors that drive performance. Can you give us some examples of these factors?
Some common factors include value, momentum, quality, and low volatility. To help visualize this, imagine choosing a car. You might consider its engine power. That's value. Safety features. That's low volatility. And design, which is kind of like momentum. Similarly, in factor investing, you select investments based on these underlying characteristics. And by diversifying across multiple factors, you diversify across different sources of return.
So you're not putting all your eggs in one basket, so to speak. How does factor investing play into the issue of unpredictable correlations?
Factor-based portfolios can exhibit different correlation patterns compared to traditional market cap-weighted indexes. So they might move differently from the overall market, potentially enhancing diversification during periods when traditional correlations break down.
So they might zig when the market zags. But, like with any investment approach, there are risks and nuances to consider.
Of course, it's essential to understand the specific factors you're targeting, their historical performance, and how they might behave in different market environments. Again, research is key. There are no shortcuts. And we will be diving deeper into factor investing in upcoming episodes.
Excellent. Now let's talk about tactical asset allocation, which seems like a more hands-on approach.
Right. Tactical asset allocation involves actively adjusting the portfolio's mix of assets based on changing market conditions and economic outlooks. So instead of maintaining a static 60/40 split, you're constantly tweaking it to potentially capitalize on short-term opportunities or mitigate risks.
Can you provide a couple of examples to illustrate this?
Sure. For example, if you anticipate inflation to rise, you might tilt the portfolio towards assets that historically perform well in inflationary environments, like commodities. Conversely, if you see signs of an economic slowdown, you might increase your bond allocation to reduce overall portfolio volatility.
That sounds pretty complex. Who would this strategy be best suited for?
It's generally more appropriate for experienced investors who have the time, the resources, and the risk tolerance to manage their portfolio actively. Consulting with a financial advisor specializing in tactical asset allocation is also wise.
So it's not a set-it-and-forget-it approach. It requires ongoing monitoring and adjustment. With all these different strategies, is there a one-size-fits-all solution?
No. It depends on the individual investor's goals, their risk tolerance, and time horizon. Diversification is a personalized journey. It's about finding the approach that best suits your unique circumstance.
Okay, so we've talked about diversifying across asset classes. Is that the only way to diversify?
No. Another critical aspect of diversification that's often overlooked is diversifying across time. This involves spreading your investments over time, rather than investing a lump sum all at once. This approach, often referred to as dollar cost averaging, can help mitigate the risk of investing a large sum at the wrong time.
So instead of buying all at once,
Mhm.
you staggered your investments over time, essentially averaging out your purchase price. This sounds particularly useful during volatile markets.
Exactly. You're buying assets at different price points, so you're smoothing out the average cost of your investments. This strategy is especially beneficial for long-term investors who are accumulating assets for retirement or other long-term financial goals. It helps reduce the emotional impact of market swings and can potentially enhance long-term returns.
So diversification isn't just about what you invest in, but also when you invest.
Precisely. Now let's address another common misconception about diversification. While it's often associated with higher returns, that's not always the case.
You mean the saying, don't put all your eggs in one basket, doesn't always guarantee higher returns.
Right. Diversification is primarily a risk management tool. Its main goal is to reduce portfolio volatility and protect you from significant losses. It's about creating a more stable and resilient portfolio, not necessarily chasing the highest returns.
That makes sense. So while diversification may enhance returns over the long term, by smoothing out the ride, it's not a guaranteed path to outperforming the market.
Exactly. A concentrated portfolio focused on a few high-performing assets could generate higher returns than a diversified portfolio, but that strategy carries a much higher risk. If those few investments don't perform well, the losses can be substantial. Diversification is about finding a balance between risk and return, a portfolio that can withstand market fluctuations, while providing the potential for long-term growth. Diversification is multifaceted. It's not just about spreading your investments across asset classes, but also diversifying across time and understanding the cyclical nature of correlations.
It's about knowing the factors that can influence the relationships between assets and adjusting your strategy accordingly. Are there other forms of diversification that investors should consider?
Yes, geographical diversification is becoming increasingly relevant in today's investment landscape.
We've discussed diversifying across asset classes and time, but why is geographical diversification important?
In today's interconnected world, global events can significantly impact financial markets worldwide. A crisis in one region could impact investments in another, even if they seem unrelated. By diversifying geographically, you're spreading your investments across different countries and regions, potentially reducing your exposure to risks concentrated in any single area.
So if someone is heavily invested in the U.S. stock market, adding some exposure to international markets would diversify their portfolio.
That's a common approach. International markets can offer different growth opportunities and potentially lower correlations with U.S. assets. This provides a hedge against domestic economic downturns or geopolitical risks. However, there are additional considerations when investing in international markets.
What kind of considerations?
We have to think about currency fluctuations, political risks, and potentially different regulatory environments. It's not about blindly investing in any international market.
So thorough research and understanding the specific dynamics
Yeah,
of each region are crucial before investing. Might this also involve consulting with a financial advisor who specializes in international investments?
absolutely. Geographical diversification is another tool in your diversification toolkit. It's about finding the right balance for your overall investment strategy.
With all these different layers of diversification, asset classes, time, factors, and geography can feel overwhelming. What's the most important takeaway for listeners?
Diversification can seem complex, but the core principle is straightforward. Don't put all your eggs in one basket. Spread your risk. Build a resilient portfolio, and potentially enhance long-term returns by smoothing out market bumps.
Diversification is an ongoing process that requires monitoring, adjustment, and adaptation to an ever-changing investment landscape.
Yes, it's about staying informed, staying curious, and continuously seeking ways to enhance your portfolio's resilience and potential for growth.
Now, before we wrap up this deep dive into diversification, let's circle back to that thought-provoking question you posed earlier.
The one about how investors can adapt their strategies. in a future where traditional correlations might be less reliable.
Yes, that one. Given the changing dynamics of the global economy, the evolving role of central banks,
Yeah.
and the potential for unexpected events, should we even rely on historical correlations as a roadmap for the future?
I think we can't just assume that the historical relationships between asset classes will hold true in the future.
Bro, we can't just assume that what's happened in the past
Yeah.
is going to continue to happen.
Exactly. The financial landscape is evolving, and we need to evolve our thinking along with it. We need to challenge our assumptions about how assets will behave.
So how do we adapt to this less predictable environment?
Yeah.
What does that shift in mindset look like practically?
It starts with a commitment to continuous learning, staying informed about market trends, economic developments, and emerging investment strategies. That's really crucial.
No more burying our heads in the sand. We need to be proactive in seeking out knowledge.
Precisely. And it also involves being open to new ideas and approaches, challenging our assumptions, and being willing to step outside our comfort zones.
So are you saying we need to be willing to explore strategies beyond the traditional 60-40 portfolio?
Yes, that might mean considering alternative asset classes, understanding the nuances of factor investing, or even exploring a more tactical approach to managing portfolios.
It's about recognizing that the best approach for one investor might not be the best for another. There is no one-size-fits-all solution. When it comes to diversification,
Absolutely, and we need to understand that diversification is not a static concept, but rather an ongoing process of adaptation and adjustment.
so as we wrap up this deep dive, what are the key takeaways you want our listeners to remember?
Well, first, diversification is more important than ever in today's complex and interconnected world, but it's not as simple as it used to be. We can no longer rely solely on traditional approaches, like the 60-40 portfolio. We need to be more dynamic and adaptable in our thinking.
And that means staying informed, being open to new ideas, and constantly seeking ways to enhance our portfolio's resilience.
Exactly. Diversification is not just about protecting investments. It's about protecting your financial well-being. It's about creating a sense of security, knowing you're prepared for whatever the market throws your way.
That peace of mind is crucial, especially in uncertain times. So as you continue your investment journey, remember that diversification is not just a strategy, it's a mindset.
It's about embracing adaptability, seeking knowledge, and continuously evolving your approach to navigate the ever-changing dynamics of the financial market.
And that's what we aim to provide here on The Deep Dive. The knowledge, the insights, and the perspectives.
To empower you on your financial journey.
So until next time, keep those portfolios diversified, those minds open, and those financial goals in sight.
Happy investing!